first is, how to use the index. Because I said earlier that I use the index a little bit differently than individual stocks. Now, the index actually goes through the price cycle very uniformly, in my opinion. But analyzing the index should better help you execute your individual stocks. So is what I mean by that. And I'm talking specifically here about like the Qs or the spiders. But as discussed, you'll see volatility at turning points. So markets often top and bottom on an expansion in volatility, and then you get a contraction in volatility prior to a future sustainable move. So you want to start to see that contraction before you get aggressive, because you can just have whipsaw back and forth with high volatility, and it's difficult to trade. But here's the caveat. Leading stocks will often break out or start to move before the index have their true wedge pop, right? And it's what I mean by that is the index could be having a reversal extension and putting in its low, but some of the best names will actually start having their wedge pops as the index is putting in that low. So if you're able to kind of anticipate and see that the index is putting in an extension to the downside, and then you start to see individual stocks with setups, those are setups that you can take. And really the way that you want to get exposure to the market, in my opinion, coming off a correction is, maybe you get your one or two names going when the index kind of put in their reversal extension. And then you want to look to add exposure over the next few weeks between the reversal extension and the ensuing wedge pop. So maybe you get one or two stocks going on the lows in the index. If they start to work for you, you can look for another stock or two. If those start to work for you, you can continue to add exposure. And so one of the things that I pay attention to is after the wedge pop on the index. So I'm talking not your individual stocks, but the actual index puts in its wedge pop. A good way to judge relative strength is to make sure you're playing names that are ahead of the index in the cycle. So for example, if I see the index put in a wedge pop and then it has an EMA crossback, I don't want to be getting in stocks that are showing a wedge pop when the index has an EMA crossback. Why? They're behind the index. They're laggards. You're playing them because you missed the leaders, and you're probably a little frustrated. And like, look, guys, I'm there all the time. Like, it happens, but you're not playing the best stocks in the market if you're playing stocks that are behind the index in the cycle. If the index has a wedge pop, you want to be looking for stocks that have a crossback or a basin break. If the index has a crossback, you want to be looking for stocks that at a minimum are having a crossback and hopefully are basing on the highs and ready to blow higher. That's a way that you can assure you're trading names that are stronger than the underlying index and are hopefully going to outperform and have higher percentage up days than the index. And then, so one thing I say down here, at least I think I say, so I pretty much just said that a lot of the time, by the time the index has a wedge pop, and often that can, sort of be aligned with, the quote unquote follow through day, you want to already be positioned. And if you're not, that's okay. But if you are, it's going to allow you to better handle, natural pullbacks in the market, and hold your names for multiple weeks. Now, if for whatever reason you miss the ideal buy areas, that's okay. I mean, look, nobody's perfect, but you just want to be cognizant of that and be patient and wait for good setups, wait for pullbacks, rather than chasing stocks higher. And then just the other thing I'll say is when you get a wedge drop on the indexes, and we're going to show some scenarios of, in my opinion, obvious exhaustion extensions, you want to kind of throw your correction rules on, whatever they may be. Everybody has different rules. Sort of a rule I have, I call it the 30% rule. And when I really determine that the indexes are in a correction, I try to make sure that I'm trading 30% of my account or less. And really, I don't even really want to be taking overnights, because oftentimes in corrections, you'll have like a big gap down. The market will trade higher during the day. And, you start to have some traction on some names, but then they gap it down the next day and you give back everything. So I think it's better to have rules to stay out of the market until you start to see that index reversal extension and wedge pops and other setups building on individual names. So, any questions on that, Richard?
Perfect. Yeah. Yeah. There's a quick question. What index do you usually look at in order to determine that trend and where it's in within its cycle?
Yeah, so I mostly use the Nasdaq because I trade a lot of more techy growth
Right.
type stocks. Um, if you were the type of person who liked to trade more cyclical stocks, things like the financials or oils or whatever it may be, I would more likely use the S&P, just because I think that's going to be more reflective of the names you're trading. Um, with that said, who knows if I start trading more cyclical names, who knows? I would probably start using the S&P, but I use the Nasdaq because that's more reflective of growth stocks to me.
Perfect. I think this is a good stopping point. I think I've seen a couple requests for a break. So we obviously know there's a lot of material being thrown at you. That's why these are recorded. They'll be available for you to watch as many times as you want.